Ready.
Hello everyone, welcome to Beach Investing. I'm your host, Andre Angelkowski, and today we're with a special guest, Adam Bazuk from Dominion Lending.
Thanks for having me. I'm great, thanks.
Alright, so Adam, he's a mortgage broker with Dominion Lending, and he's a PK approved mortgage broker. So I'm going to let Adam explain what exactly does that mean.
Oh, it's really special. I say that with a smile on my face, but PK approved is a designation I earned being related with Peter Kinch's mortgage group. Now, Peter Kinch is quite a well-known mortgage broker in Canada. He's one of Canada's foremost mortgage brokers with a specific focus on investors and helping investors develop a real estate portfolio from a financing perspective. So when I got the PK approved designation, it just meant some extra training and working with a lot of Peter Kinch's clients in Ontario.
Investors primarily.
Investors primarily, that's what the PK approved means.
Okay, so everyone's wondering, in today's economy, what are the interest rates doing right now? So like, well, what is happening with the fixed rate, the variable rate, and how is the crisis in Greece affecting it in the U.S. economy? How are all these affecting the interest rates?
It is that's a great question, and it's a very tricky time out there right now because of everything that's going on in the world. People just don't know more than ever what's really going to happen. So I really like what Benjamin Tal says. He's one of the foremost economists in Canada. He works for CIBC and he puts out a regular publication. And I look to the economists to, even as a mortgage broker, to give me an idea of where rates are going, because they're the guys that are truly in the know. And so for the longest time now, we've been talking about rates are going up. Rates are going up. Prime's going up. Fixed rates are going up. But they haven't gone up. In fact, recently, 2-3 weeks ago or something like that, fixed rates came back down again slightly, and prime has remained flat even through July. So what Benjamin Tal says is, which I think is very astute, is that things like the U.S. economy slowdown, which doesn't look like it's going to pick up anytime too soon, the Greek crisis, the high Canadian dollar, other factors like that, they have essentially just stalled an inevitable rate increase. And we'd be naive to think that we're not going to see rate increases in the future. And in a recent article he did, what he suggested was that if we continue to stall for too long, it'll cause inflationary effects and could eventually lead to even steeper rate increases. So he is suggesting that the Bank of Canada should start to raise interest rates, albeit slightly, sooner than later, because the lengthy stall will cause problems in the future, and he doesn't think they'll let that happen. So what does all that mean? If you believe Benjamin Tal, which I do, we will likely see a quarter point increase to the overnight rate in September. They won't stall any further, so 0.25% increase, and probably a full 0.75% increase by the end of the year.
Really?
Yeah.
Okay. Well, what's better, variable rate or fixed rate in today's market?
Okay, well, I'm a mortgage broker, so I'm trained not to answer that question straight on. I'm just kidding, but it's a truly a personal choice, fixed or variable. So I do have my own personal opinion on that, which I share with clients. So here goes. Fixed rates are at historical lows still. So you can get an incredibly low 5-year fixed rate right now, hovering still around 3.5 and change if you have a good broker or banker. And there is absolutely nothing wrong with signing on the dotted line for a 5-year fixed rate right now. We know fixed rates are going to go up. That's inevitable in 1 year, 2 years. We know they're not going to get much lower than they are right now. So you're not, I guess what I'm saying is you're not going to lose any sleep by taking a fixed rate. And that's a good strategy for using the sleep analogy again, for someone that is going to just be panicking about having the variable. You know who you are. You know, if you can get through the day without looking at the paper to see if the variable went up. It's not something that you're supposed to have to look at every day. But going back to what I just said about will rates go up and everything like that, I am still a big fan of the taking the variable rate with a particular strategy in mind. Right now, the discounts on the variable are very, very good. You know, prime minus 0.85 or 0.9 or 0.75 depending on the situation, which means that your rate today 2.25, 2.3 because prime's at 3%. And if you listen to the economists, we are going to see some increases to prime, but not tremendous. And because prime is lower than fixed rates today, it's going to take a considerable amount of increases before your rate is even equal to today's fixed rates, given your discount off of the variable. A strategy I like to talk to my clients about, just to wrap up here, is to take the variable rate but set your payment to what it would be if you took the fixed rate. That's a winning strategy for two reasons. You're pocketing money that otherwise the bank would have normally had, and you're targeting your mortgage and you're accelerating repayment of your mortgage while rates are very low. But at the same time, you're also training your budget, and what that means is that, you know, you're already used to the higher fixed rate payment. So if prime starts to creep its way up, and 18 months from now, you know, prime's at 4.5% and your rate's at 3.6, that's no big deal to you because you're already used to that payment. And in the meantime, you've saved all this extra money. I'm not a big fan of taking the variable and going on a shopping spree because your mortgage payment's very low.
Oh, okay.
Sorry, Andre.
Too bad. Okay, well, there's a lot of investors out there, or soon-to-be investors who are looking to learn about it. They want to understand on how to build a real estate investment plan. What are your suggestions on that?
Okay. Well, first I want to say that having a plan if you're going to be a real estate investor is essential. It's as we said at the outset, I'm a PK approved mortgage broker. I work with a tremendous amount of investors, and we talk to our clients about taking a portfolio approach versus a transactional approach. What does that mean exactly? It just means that before you embark on purchasing investment real estate or adding to your portfolio, you should really sit down with someone that knows how to work with helping you set your goals. How many properties do you want to own in the next 5 years, the next 10 years? Why do you want to own them? What are the main goals? Is it income replacement? And so our focus needs to be one thing. Is it capital appreciation? So our focus needs to be something else. And once we have our goals, we can then take a portfolio approach, as I said, which is making sure that what we do today does not negatively affect what we do tomorrow. A transactional approach is where you just walk in and say, give me a mortgage, and because you qualify, the bank gives you a mortgage. Very dangerous, because as you learn, if you are going through a planning analysis, as you start to accumulate investment property real estate, the bank starts to look at you a certain way. If you've structured things properly, it's only going to improve your chances for doing more and more things if you've acquired real estate. If you do it the wrong way, it's going to negatively affect what you're doing in the future. It's going to sound like a little plug. It's truly not. I don't get any royalties, but Peter Kinch's recent book, The Canadian Real Estate Action Plan,
Yep.
is an incredible book that I think any future investor should read. Main reason why is because Peter Kinch used to conduct a $1,500 daily seminar to help people learn how to plan for real estate, and now he's condensed it into a $30 amazing book. And it's certainly a great starting point. And then you have to seek out a human being that can help you.
And such as yourself.
such as myself,
who's very investor savvy, and you understand the investment game, and you play in that game yourself. Like, you own investment properties.
From the financing side, most definitely, and if not me, there are some others. It's all about building your team. If you're going to be an investor, you need a mortgage broker that is investor savvy. You need a real estate agent that is investor savvy, like you, Andre. You need a lawyer, an accountant that are, some accountants might not have a lot of experience working with investors and the statement of real estate rentals and all these things. So you got to assemble your team around you, and it's very important.
Okay.
Yeah.
And the last question we have for you is actually a very popular one with my investor clients.
Okay.
And I'm going to read this out to you because they've actually asked me to read it word for word. So, one popular strategy is buying a property, renovating it, and then refinancing it. And then getting back your renovation money back after you refinance,
Yeah.
and then holding it as a long-term rental. Now, how feasible is this strategy from a financing standpoint? And do the banks, lenders, shy away from these strategies?
That's a great question. And it's a great strategy. We just talked about planning. I mean, one of the things we would sit down and talk to our customers about is, what type of real estate investor do you want to be? Are you getting into student rentals? Do you want to do rent to owns? Do you want to do buy, reno and hold, buy, reno and flip? By far, one of the best ones, depending on your goals, is buy, renovate, and hold. And those that do this well make a great livelihood, and it's very rewarding. So getting back to the question, how do the banks perceive it? They don't mind it at all. They love it, and I'll tell you why. First of all, they do have the products out there that allow you to acquire the property, and with the ability to refinance at a later date without paying any penalty. That's what those products are designed for, shorter term hold type, open line of credit type products, and you'd want to work with a broker that understands that that's what you want, because if you're going to do a 3-month renovation and then refinance, you definitely don't want to get into a 5-year closed mortgage where you're going to be paying a penalty. But the banks embrace this type of philosophy because this is one of the reasons they have these types of products. Then what are we saying to the bank? We're saying, hey bank, we're going to spend $40,000, $50,000, $60,000, $20,000 improving this property over the next 3 months that you've just registered a mortgage against. Mm-hmm. Not only improve the value, but just flat out improve the property, which is the asset that the bank has. One of the things the bank has based their decision on giving the loan. Anytime you tell a bank, "I'm going to improve the property," they love you. So out you go, you improve the property. And are they against the value going up because you did these renovations? Absolutely not. They know their appraisers are going to do an accurate job and come back with a very accurate appraisal based on what's going on that street and that market and the renovations that you've done. And so refinancing and pulling out equity, not a problem. And because it's a hold strategy, you're going to be able to rent it for top dollar, for a better dollar, but they're going to have their mortgage with you for longer. So you're not saying, I'm going to reno and flip it, adios. Yeah. So they're happy to have you around. Yeah, that's really my answer on that. It's a great investment strategy and can work out very well for everybody, including the bank.
Good. For those investors out there looking for this strategy, you just heard it. Banks are actually not shying away from it. They actually encourage it in certain cases. Thank you so much for coming out.
No problem. I appreciate the opportunity.
Doing this interview. I appreciate it.
No problem. Thanks, Andre.
Thanks, guys.